Hi, everyone. I'm Kieran O'Dwyer, Vice President of Corporate Communications at Mutual America Financial Group. Thank you for joining our final Economic and Market Perspective webinar of 2022. Today's focus is inflation's impact, both during 2022 and as we look at what may lie ahead for the financial markets, economy, and consumers in 2023. Of course, inflation is on everybody's mind these days. And as it begins to ease, there are key factors to consider, from the labor markets to food prices, the housing market to gas prices, and more. And what may look like a positive or negative sign in the Federal Reserve's attempt to cool the economy and address inflation may not necessarily seem like a positive or negative at first glance to consumers. As always, to help us make sense of it all with his expert insights and analysis, please welcome Stephen Rich, Chairman and CEO of Mutual of America Capital Management, LLC. Thanks for joining us again, Stephen.
Thanks for that introduction, Karen. Happy to be here today and discuss some of these topics.
Great. Well, so I guess where I want to start here is this year, we've all experienced the impact of inflation. Most clearly, I think people seen that at the supermarket and gas station. But first, let's talk about its impact on the financial markets in 2022. It has been an unusual and volatile year with both stocks and bonds suffering. In a sense, it seems the markets have been anticipating what's going to happen with inflation in the economy.
Yes, Karen. As you can see from this chart, that the equity markets have suffered this year with the majority of the indices down a considerable amount. What actually masks a little bit of some of these returns as well. Through November, there are negative returns across these indices. We have had some rallies in the market. In fact, from June to August, we had a 17% rally in the S&P, and then through October through November, the S&P has actually been up 14%. So the market continues to try to anticipate. They are anticipating that the economy is slowing and will slow as we go into 2023. But that being said, it's also trying to figure out at what point the Federal Reserve is going to pause its rise in interest rates. The other observation that I would make from this chart is that value has significantly outperformed growth. And you can see that by looking at the Russell 1000 value index, which is down 3.7% versus the growth index, which is down 23.3%. That's almost a 20% difference in those two indexes. There are really two reasons for that. One is coming into the year, growth stocks were more expensive than value stocks. And then the secondary is that growth stocks tend to have cash flows that are further out in the future. And in a higher interest rate environment, when those are discounted back, they're less valuable. So those are some of the key things that have been going on in the equity markets. Now, if we turn to the bond market, bonds have done what I'll say marginally better than the equity indexes. This is one of the worst years on record for the bond market. And in the last 45 years, there's actually only been 5 other occasions where bond markets have been negative for the year. So if things stay on course where they are through November, this would be another, one of those years that bonds have a negative return. In fact, there's a New York University study that says that bonds haven't had a double-digit negative return since 1931. So that's been, a long time, and we haven't seen bond markets react this way. And this is a result of the Fed raising interest rates. As interest rates rise, the value of bonds goes down, and it's reflected in these returns. Even the popular 60% equity portfolio and 40% bond portfolio has suffered this year. This has been a bellwether for investors over the last few decades. And on a year-to-date basis through November, that strategy is also down over 13%. So it's been a tough year for both equities and bond markets. as I said, we'll continue to watch the Fed and see how aggressive they are in continuing to raise interest rates.
I would like to shift now to the Fed and starting with inflation. There's a dizzying, really, amount of data available on the subject. Would you take a minute to walk through some of the key government inflation gauges just to help us understand those before we really dive into some of the factors behind inflation?
Sure, Karen. That's an interesting question. What we've shown here in terms of a chart is the CPI, and this is the Consumer Price Index. This is the widely or most widely known index that people watch, and you can see that for many years the CPI, or as a proxy for inflation, had been quite low. And up until the early part of 2021, it was rather tame. But you can see as we've moved through that period to the present time that inflation has risen a great deal. While it peaked in June at 9.1%, which was the highest level since November of 1981, it's currently backed off a little bit to 7.7%. But this is still a very elevated level, certainly relative to the Fed's target of 2%. And this is the 20th straight month that the CPI has been above that 2% level. And there are a couple of reasons why inflation has come into the economy. One is global commodities. The second is strong consumer demand. The third is wage increases. And the final reason for increases in inflation across the economy are supply chain bottlenecks that we've all heard about as a result of coming out of COVID-19. There are some additional measures that I think are important to focus on. The other two measures that the Federal Reserve looks at is the personal consumption expenditures, or PCE. This is running at about 5%. This is also above the 2% level that the Federal Reserve targets here. And then the PPI has been running quite strong. The PPI is a producer price index, and that stands at 8% in the most recent capture of that data. So all of these indices are pretty hot, and this is really why the Federal Reserve has embarked on a strategy to tame inflation.
In some respects, it seems hard to believe that it was back in June when inflation hit a 40-year high of 9.1%. And while it has eased in recent months, it remains persistent and at elevated levels. What's happening here? Can you take us through that, please?
Well, the Federal Reserve, as we've said before, has embarked on an aggressive strategy to tighten monetary policy and really to cool the economy. And there's a two-pronged approach to this. One is by increasing interest rates, and the second is to reduce the amount of bonds that it holds on its balance sheet. The first one, increasing interest rates, is probably the one that people focus most on. And this year, we've seen a historic amount of tightening. In fact, we've seen 7 interest rates for a total of 4 percentage points thus far this year. We've seen a record of 4 consecutive 75 basis point increases. We have not seen this much tightening since 1980. And if we look at the chart here, we can see that at the beginning of the year, interest rates were at or near zero, and at the current time, they stand at 4%. Chairman Powell's most recent comments that he made at the Brookings Institute perhaps were received as a little bit more dovish than his comments back in August at the Jackson Hole Symposium. And it's now widely consensus that there will be another rate hike in December, however, not being 75 basis points, but perhaps 50 basis points. And while the stated remarks from the Chairman Powell is to continue to aggressively fight inflation through raising interest rates, This is a slowing in growth, going from 75 basis points at the last meeting and anticipating a 50 basis point one in the upcoming meeting. Now, the future markets are also predicting that rates will peak in the second half of 2023, with peak rates being at 5%. So we've got some more room for rates to go up, but that pace that they've been going up is beginning, or it's anticipated in the markets that it's going to start to slow.
There are a number of I'd like to talk to you about a number of the key drivers that are keeping inflation levels elevated right now, namely food prices and the tight labor markets, which you alluded to earlier. Regarding employment, the Fed seems hopeful that higher interest rates could cool the economy by slowing job creation without widespread layoffs. Take us through both of these factors of food and labor and what we might look out for.
Right. So these are two areas that remain, in my opinion, pretty hot or elevated and are challenged to bringing down inflation at the current time. The first one is the employment market. The employment market is as strong as it's been in the last 50 years. Unemployment, as you can see from this chart, sits at 3.7%. Once again, this is at or near historic lows. And job creation throughout 2022 has been extremely strong, with an average of over 200,000 jobs being created each month. Additionally, there continues to be over 10 million job openings as measured by the JOLTS index. And what's probably most concerning to the Fed is that wages continue to increase. The latest reading in November was that wages have increased 5.1% year over year. And so as wages increase, this allows people to spend more, which will continue to keep inflation elevated. So one of the keys here, unfortunately, is in order for the Fed to tame inflation, we're going to need to slow the job market, which will probably start to increase the unemployment measure as we get into 2023. On the issue of food, many food inputs continue to be quite inflationary, and there are a couple reasons for inflation that's worked its way into the food costs. One is supply issues. The second is energy costs. The third that's related to energy costs as well is the cost to transport these goods. And then the final piece, which goes back to the unemployment issue, is labor and tightness of the labor market, as well as wage growth. But you can see from all of these various food groupings that food has been quite elevated, and so this continues to be an area that we need to see some relief if we're going to ultimately bring the levels of inflation back to normal.
That said, the economy is feeling the effects of the Fed's monetary tightening. We've seen a rapid increase, for example, in consumer mortgage rates and a softening housing market, as well as a continued decline in gas prices and various industrial commodity prices. If you would talk about these and just the work that the Fed still needs to do in the short term to continue to bring this down, inflation.
Yeah, one of the immediate ways that the Fed can start to slow the economy is by raising interest rates, as we talked about. And there's a direct and immediate correlation with mortgage rates and interest rates. And so from this chart, we can see that mortgage rates have started to climb and climb quite rapidly. If we go back to April of 2020, a mortgage rate stood at 3.3%. If we fast forward to October, the end of October, mortgage rates are well over or are over 7%. The last time rates were over 7%, you have to go all the way back to April of 2002. So as mortgage rates go higher, this obviously stops the amount of buying and selling of homes. And if we look at the next chart, which I think is even more dramatic, we can see that home sales have really started to fall as well. After peaking in May of 2021, where there was a recording of over 41% increase, now we look at the same market and we see that it's down almost 30%. And this is a direct result of higher mortgage rates. The term is that homeowners are locked in, and homeowners are locked into their houses because they can't afford to trade out of their old house into their new house because mortgage payments would be so much higher relative to where they are. And so this is one of the direct and most easy ways that we can see the effects of higher interest rates working on a very, very significant portion of the economy. So once again, we would continue to think that the housing market will continue to slow throughout the remainder of this year, but also into 2023.
Talk a little bit about the issue as it relates to the decline in gas prices and commodity price.
Right. So, you know, gasoline is obviously something that's front and center to almost everybody in the country. And if we go back to June of this past year, gasoline prices on a national basis peaked at $5.11. Higher gas prices works its way into almost every part of the economy, whether it's for transporting goods or it's transporting people to travel, to go to work, to commute, et cetera. So this is a direct almost tax on people as gasoline prices go higher and higher. As you can see, gasoline prices currently stand at $3.65. While this is higher than we saw back certainly in 2020, it has come down, and this is another sign of a helpful part of the economy that should begin to help lower inflation. And one of the main reasons why gasoline prices have fallen this year, or at least from the June high, is that the Strategic Petroleum Reserve has been releasing 1 million barrels of crude a day. That's almost 275 million barrels. And so this is one of the ways that the government has tried to send some amount of relief in the gasoline industry. If we look at the industrial commodities, we see that these are starting to slow as well. And to me, this means, or is a sign that companies are starting to reduce their inventories as they prepare for a slower economy. And you can see reflected copper, aluminum, silver, and iron ore on a year-over-year basis are all down. And so once again, this is a sign or a signal that some of the effects that the Federal Reserve has started to affect on the economy is starting to work, but there is more work to be done.
Finally, I have a two-parter for you. First, looking at 2023, I wonder, what are some of the key challenges the Fed may face as they continue to attempt to slow the economy without tipping it into a recession? And second, I'd like to go back to the financial markets to close and get your sense on what might this all mean for stocks and bonds and the financial markets overall heading into the new year.
Right. So, yeah, I believe that the Fed will continue to fight inflation, and as a result, this will slow the economy as we go into 2023. I think that's pretty much consensus of most economists out there. And yes, you are correct. The Fed is trying to balance both slowing the economy, but not slowing it too much. And they're trying to engineer what we call a soft landing. And so this is the balancing act that the Fed is embarked on as we sort of go into the next year. We do believe at some point that the Federal Reserve will stop or at least pause raising rates. And we believe that that would be a very good backdrop for both bonds and stocks to improve, certainly from the levels that we find them today. So we see some short-term volatility will continue in the market. However, as we get into 2023, this may actually be a pretty good backdrop for both stocks and bonds.
Great. Thank you so much, Stephen. That was very insightful, and we appreciate you taking the time to share your insights again with us, and look forward to our next discussion in 2023, which is right around the corner.
Yep. Thank you for your time today, Kieran. And I want to just wish everybody happy holidays and a great new year. And we'll see you back here in 2023.
Thank you, and same to you, Stephen. This concludes our webinar. As we plan our next economic and market perspective with Stephen in early 2023, we'll be sure to send you an invitation and hope you'll join us again. But before you leave, if you would please take 1 minute to complete a brief survey about today's presentation and let us know about topics and issues you might like to hear more about in the new year. Finally, today's webinar will be available soon on mutualofamerica.com to watch at your convenience. Thanks again for joining us. Have a safe and happy holiday season.